Hello everyone, good afternoon. Welcome to our already 7th episode of our Basel IV channel. I'm very glad to have you all with us. It is really a pleasure to see the interest in our channel increasing over time, and we get quite a lot of your feedback, which of course we try to further improve the channel. Before getting into the details and introducing also my co-speaker, just a very quick intro around the Basel IV channel, which we have explained also in the previous episode, but for any new joiners, when we started our Basel IV initiative and when Basel IV really became significant changes coming from the Basel Committee around the new calculations for RWAs, risk-weighted assets, we thought, what is the best way of connecting with you? So connecting with our clients, connecting with the banks, and instead of, we thought about sending newsletters or doing other things periodically, we thought this new way of basically communicating with you through a webinar in which we try to cover a specific topic, do that brief in 30 to 45 minutes, and do this regularly, like once a month, to keep you updated about all the new changes or developments that come from the Basel Committee and related changes around regulatory reporting. Today we basically have a special topic or a special edition. I think the last time, this was 2 weeks ago, we had we said we will have a special topic today, because the topic is IFRS 9, so you would normally think that doesn't have anything to do with Basel IV, but of course there is quite some overlap, so we thought about doing this special topic and explaining what the impact or some of the impacts of IFRS 9 are on regulatory reporting, of course in combination with the changes that we will see in regulatory reporting, particularly around Basel IV. But it's a special topic, which means this is already after 2 weeks of the last episode, and the next episode will be another 2 weeks on the 28th of October. And as you all know, this is being recorded, and we'll be uploading this onto YouTube, so you'll have any chance to watch basically the recording of this episode. So before going to the details, I would like to give a quick time to Peter Büttel, who is my co-speaker for today. Peter, could you briefly introduce yourselves?
Yes, thanks, Abdellah. Yeah, hi everybody, my name is Peter Büttel. I'm Senior Manager at PwC in Germany. I'm part of the regulatory management team. I'm responsible for the regulatory audits in Germany, and I'm responsible for several implementation projects, started with Basel II, Basel III, pre-studies, Basel IV, and one of a lot of projects we did around IFRS regulatory conversion projects, based on IAS 39 and now based on first implications of IAS 39 and now IFRS 9, the first implications of IFRS 9 to the regulatory reporting. And I'm looking forward for the next 20 or 30 minutes to share with you our experience on IFRS 9 and the regulatory reporting. So
thanks a lot, Pete. Yeah, thanks a lot, Peter. My name is Abdellah. I think you've seen me in I think most of the previous episodes. I'm based in Amsterdam. I'm the Deputy Global Basel IV leader of our initiative, and I'm running our regulatory practice in the Netherlands. And it's, again, as I said before, always very interesting to share with you some thoughts and ideas from our side. So for today, how does the agenda look like? Of course, we first try to give you an overview of IFRS 9, very quick. What are the changes? How does I-39 transfer into IFRS 9? How does IFRS 9 look like? Then the basically impacts on initial application of IFRS 9, particularly in, of course, in 2018 initial application. Then we'll go into some more comparison between IFRS 9 regulatory reporting and some overlap around the loan loss provisioning, or ECL, and some important topics that have clear overlaps, including, for example, the default definition. Then we'll get into another specific overlap, which is around liquidity. So it's not only the capital framework, but also around liquidity and the liquidity buffer, so the LCR. We'll discuss that, and then we'll basically close with a summary of some additional regulatory implications or interactions between or with IFRS 9. So it's, I think, a full agenda. We'll try again to keep it within the 30 minutes, and hopefully you will enjoy this session. So to start with the overview, how basically IFRS 9 substitutes IAS 39. So this is what you see now on the slide, is particularly around classification measurement, as IFRS 9 will cover classification measurement of financial instruments. Financial instruments are simply all, say, loans, liabilities, derivatives, bonds, and those type of instruments, to summarize, without bothering you with the specific IFRS definition of financial instrument, because typically the definition in itself is not very self-explanatory. So how IAS 39 is replaced from a classification measurement perspective, you see on the left side, you see the current classification under IAS 39. So basically we have, and then of course the related measurement. At the left side you'll see the measurement, which is amortized cost, fair value through OCI, the fair value changes through OCI, through equity, or fair value through profit and loss. And then next to that, on the right side of it, you'll see the four basically classification buckets under IAS 39, which is loans and receivables. Typically we'll see there, say, normal lending business, a hold to maturity. In the hold to maturity, you could have quoted instruments that are hold to maturity, available for sale, are typically non-trading quoted instruments, are normally in the AFS portfolio, which is available for sale. And then fair value through P&L is typically all instruments that are, for example, trading instruments or designated through fair value through P&L. And derivatives are also measured at fair value through P&L, provided that cash flow hedge accounting is not applied. So how does the classification change under IFRS 9? So basically, if we look at the different type of instruments, so debt instruments, equity instruments, and derivatives, I think that's an important basis to look at IFRS 9. And then it's important to understand that under IFRS 9 there is this concept of a business model and the concept of so-called SPPI, which basically means solely payment of principal and interest on the principal outstanding, which as a starting point under IFRS 9 for a debt instrument is to basically assess whether the debt instrument is held in a business model, which is interesting as a new concept under IFRS or IFRS 9 for financial instruments, as it didn't exist under IAS 39. Basically, you assess whether what the business model is, and the business model for a particular instrument could either be hold to collect, so the instrument is hold to collect the contractual cash flows, or the business model is hold to collect and sell, which basically it's a mixture of collecting contractual cash flows and basically selling instruments, financial assets. And the third basically is a, say, rest category, which is other. And basically that business model drives the classification measurement, or the final measurement, whether it's amortized cost or fair value. As a second, after the business model assessment, the so-called SPPI assessment has to be performed. So whether the contract gives rise to solely payment of principal and interest. And basically we say it should be a basic lending agreement, so no leverage features or any, say, links to certain indexes that are not related to the specific counterparty and so on. So if the financial instrument, say this loan, is held in a business model that's hold to collect and it meets the SPPI test, it will be measured at amortized cost. If its business model is hold to collect but it fails the SPPI test, it goes to fair value through P&L. If it's hold and sell and it meets the SPPI, it's basically fair value through OCI. Interestingly, with those changes that are booked in fair value will never be recycled to P&L, opposed to what's current I-39 practice. And then basically it's hold and sell and it fails SPPI. Basically failing SPPI means fair value through P&L. Then as said, if it's trading intent, so the business model is not hold to collect or hold to collect and sell, it's also by default fair value through P&L, where there is an option for equity instruments to classify at fair value through OCI, and derivatives are always fair value through P&L, again provided cash flow hedge accounting is not applied. So classification measurement, most important here, the same type of measurement is still applied, so amortized cost, fair value through OCI, fair value P&L, difference fair value through OCI, it stays in fair value through OCI, it doesn't recycle through P&L. And this whole concept of business model is very important. We'll also see some link with regulatory, and of course all the changes upon transition will have an impact on capital. So this is basically the first bucket, which is classification measurement under IFRS 9. Second bucket is around impairment, so loan loss provisioning, where basically IFRS 9 moves from a incurred loss model under I-39 to an expected loss model under IFRS 9, which means a bank will have to take into account future credit losses when determining impairment. And then within this basically impairment phase or area, there are three buckets which then basically drive whether a 12-month expected credit loss is determined, which is basically the first bucket, and for the second and third bucket, lifetime expected credit losses have to be determined, which is quite a new overall of the current I-39 impairment model. And then the third basically phase is around hedge accounting. Most of the banks will not be applying yet hedge accounting as of 2018, because the hedge accounting project of the ISB has not been finalized, particularly around macro hedging, which is very important for, or portfolio hedging, which is very important for banks. So brief summary, classification measurement is basically the overview as I discussed earlier, and basically the decision tree to arrive to the measurement, whether amortized cost, fair value through OCI. So moving forward, after having given you an introduction to IFRS 9, it is very, of course, very challenging to do this very, I think, extensive overhaul of I-39 into just a couple of minutes. But it's, I think, an important introduction to this topic of today. So if we move forward and we look at the, say, summary of effects on regulatory, we just present here a overview of, I think it is a non-exhaustive list of basically, let's say, linkage between regulatory and accounting or impacts. To start with, I think I referred to before, implementation date or transition in 2018, provided early adoption is not applied, of course. There are, of course, a couple of impacts from reclassification of instruments, which have, of course, or potentially have an equity impact and so have a capital impact. we'll discuss later on a proposed phasing in of the effects by the Basel Committee and perhaps also by the European Commission. Then, of course, the book value is could potentially change, which is relevant for the exposure value, not only for RWA purposes, but also for leverage ratio and large exposures. Then if we move to basically the effect of loan loss provisioning, the effect is dependent on the whether the standardized approach for RWA or the internal ratings-based approach is used for RWA, because on the standardized approach, the basically loan loss provision, of course, provided a specific credit risk adjustment, is taken into account in the exposure value, whilst under the internal ratings-based model is taken into account through the so-called IRB shortfall calculation, where basically the accounting provision is compared to the IRB expected loss, and any shortfall, i.e. accounting provisions being lower than the IRB expected loss, are deducted from capital in summary. Then, of course, also related to, I think this point related to either both the initial implementation or implementation of IFRS 9 is basically whether the financials have been assessed or reviewed by the external auditor. If that's the case, of course, interim profits can be taken into account. If not, you can't take interim profits into account, which is relevant for P&L and for the OCI. And then, of course, also the basis or the assessment base, i.e. the book value, exposure value, will not move if there is no review. So it has also quite a significant impact. You could end up using I-39 numbers to calculate RWAs and so capital ratio. Then I think prudential filters relevant. Of course, the AFS category, which is fair value through OCI, is eliminated under IFRS 9. In the just years ago, the first exposure draft IFRS 9, there was no fair value OCI category at all. Now there is a fair value OCI category, and I think on the longer term, the discussion around whether the prudential filter will come back or not, since the idea of removing the prudential filter was anticipating on IFRS 9 not including a fair value OCI category. Prudent valuation, of course, that's driven by the assets and liabilities measured at fair value. So depending on the outcome of IFRS 9, and so a reclassification of financial assets into fair value or out of fair value, the prudent valuation amount will also change, and it could of course be an increase or a decrease. I think the default definition is very important. There is of course the EBA project around internal models, where one of the topics is the definition of default, and since banks are leveraging regulatory models, i.e. the IRB models for loan loss provisioning under IFRS 9, any changes in the default definition, meaning change in the regulatory models, meaning change or potential change in the IFRS 9 expected credit loss models. Liquidity buffer, will get into that later on. And of course, there is the new FINREP, which of course is relevant because it follows basically, say, the financial statements, balance sheet, P&L, and all the, say, disclosures. And since IFRS 9 is changing the balance sheet, P&L, and disclosures of a bank significantly, FINREP is also changed. So the EBA has put forward the new FINREP, and of course dependent on the final endorsement of IFRS 9 by the European Commission. And then last but not least, some interaction with the fundamental review of the trading book or the market risk framework, which we will also discuss in some more detail in a few minutes. So this is in a nutshell overview, and to be honest, the more we work with this and the more we interact in IFRS 9 projects, basically the longer the list becomes and the more interaction we see between, say, Basel, whether it's Basel 3, 4, and IFRS 9. And I'll hand over to Peter to tell us some more about the effects of initial application.
Yes, thanks, Abdellah. Yeah, the first question to be answered is the treatment at the application date. The question, when the banks have to consider the IFRS 9 effects on categorization and on valuation in their regulatory accounts for the first time. This is basically not new. We had already before CRR similar rules, but it's basically depending on the question using so-called a dynamic approach or if banks have to use a static approach. That's depending. Dynamic means that banks consider the IFRS 9 figures and all actual values directly at their reporting dates. They're only allowed to do that when they have a P&L or OCI loss. So they have to deduct this loss directly from the capital, and so they have a dynamic approach on all relevant figures, or they have, in accordance with Article 26 CRR, the supervisor approval. The supervisory approval depends on some criteria. It's clear banks need either they need a final audit certification or they need this approval, and so they need the guidance they need for their quarterly reporting and report. They need clarification from the auditor and a supervisor based on this. They approve, so they can use all actual figures and especially the IFRS 9 figures for the first reporting date in 2018. We see that the supervisor is actually very interested in the IFRS 9 effects. We can see there are BCBS papers, they were published a few weeks ago, BCBS 385, 386, and the supervisor is discussing how to consider the IFRS 9 additional provisions in the regulatory reporting. One paper deals with the question what can be a new approach, for example, a new approach also for the standardized approach. Do we need something like a expected loss model also for the standardized approach? And the other paper is discussing whether we need a transitional period for the IFRS 9 effects. So we can see the regulator is very, very interested in what this means, especially for the capital requirements, for the capital deductions, and is discussing it. So maybe we have a special regulation, especially for these topics. We discussed capital impact, but banks have to align their capital treatment with their exposure treatment. So we do not only have impacts on capital positions, on the OCI, the P&L effects. We also have for capital deductions. We also have implications for the exposure values. So that means for risk-weighted assets, for leverage ratio, for large exposure, for example. I would like to go to the next slide. We have picked out the definition of default, one of the key issue, and EBA published the last weeks some new documents for clarification and unification of the default definition. In accordance with Article 178 CRR, you can see it on the top of the slide, on the left side. An obligor is past due after 90 days. There exist some rules for example, for retail exposures. There are some voting rights for the past due definition of 180 days. On the other hand, on the right side, the IFRS treatment, they don't have any voting rights. There is the past due definition after 90 days, and that will lead to a stage 3 classification. So there's a difference, and we recommend banks to bring this in line, these default definitions. The second point, the obligor is unlikely to pay its obligations. A default shall be considered to have occurred in accordance with Article 178. That means there's also a difference between the regulatory and the accounting treatment, and especially the third point, restructuring measurements are a criteria for the regulatory default. For example, the restructuring measures which will lead to forborne exposures. Distressed restructuring, for example, on the accounting side will lead maybe to stage 2 or to stage 3. On the regulatory side, it will lead to a default. So it's not possible to say default on the regulatory side is stage 3 on the accounting side. That's one point. It could be stage 2 on the accounting side. And looking at the values, there are differences in calculating the provisions on the accounting side and expected loss values on the regulatory side. So it's not possible to compare exactly the values stage 3 with the defaulted exposure. So it's recommended to the banks to ensure to align the definitions and to clarify what are the differences, to be able to explain some shortfalls. And we see there a systematic difference between both rules, both sides, the regulatory side and the accounting side, and it's recommended from our point of view to clarify what are the differences and to be able to explain these to the regulator, to the management, and so on. So on the next slide, we picked out some special rules, or based on BCBS 362, some rules for PD and LGD estimation. On that point, I would like to refer to our next channel on November the 11th. We have a special edition part 2, similarities and differences of IFRS 9 and IRBA risk parameters. And in this channel, we'd like to discuss more in detail what are the differences between the regulatory treatment or the calculation and the IFRS treatments. But on this page, we see that there are a lot of restrictions on the regulatory side. For example, some flaws for PD estimation, some flaws for LGD estimation. We do not see like this on the IFRS treatment. And for the standardized approach, there impacts for the expected for the exposure values where we can deduct the provisions. So there are also influence this standardized approach values. But as I told, I would like to refer to the next channel. There will be discussed these points more in detail. So Abdellah, I would like to hand over to you for the IFRS 9 impact on regulatory risk provisions.
Yeah, thanks a lot, Peter, very clear. I think linked indeed to what you've just explained to us, how basically the provisions are interacting with regulatory, so the accounting loan loss provisions. So I've tried to explain, I think in the introduction, the 3 stages under IFRS 9 impairment. So stage 1 being 12 months expected credit losses, and then stage 2, basically you move from stage 1, or a loan moves from stage 1 to stage 2 when there is a significant credit risk deterioration. So, and then expected credit loss has to be calculated for the lifetime. And then basically stage 3 is basically, say, the credit impaired loans, or what we basically currently consider under I-39 impaired loans. And then the expected credit loss is also a lifetime expected credit loss. So how does those provisions basically affect regulatory? As for example, for IRB banks, the so-called shortfall calculation, where expected losses under the regulatory models are compared with the loan loss provisions, basically could provide either a shortfall or an excess or a surplus, which means if the regulatory expected loss, which is basically 12-month expected loss amount, is higher than the accounting provision, that difference is deducted from CET1. And on the other hand, if there is an excess, there is so a surplus. This basically can be added to capital, but to Tier 2 capital, of course, with a cap. Why is this relevant? It basically will drive the actual CET1 and hence the actual capital ratio impact upon transition. Because a bank that currently has a shortfall would basically use that shortfall to dampen the effect of any increase in loan loss provision under IFRS 9. Because the, let's say, IFRS loan loss provision will increase and will only start affecting CET1 at the level that it exceeds the IRB expected loss amount. So a bank with a shortfall basically has basically a dampening effect. And of course, if it's a surplus, i.e. the provision is already higher, then of course any increase would directly have an impact on CET1. It lowers CET1, and then there is some room to add back to Tier 2 capital. But of course, most focus is on CET1 capital. Again, and of course this doesn't, of course, fly for standardized approach banks or standardized approach portfolios. If basically any increase in provision under IFRS 9 would have a direct CET1 impact for the standardized approach instruments. The only, say, kind of a dampening effect results from the fact that the exposure value will decrease. As said before, the credit risk provision would decrease the exposure value, provided this is a specific credit risk adjustment. As we know, in basically Europe, the EBA had concluded that IFRS or I-39 provisions are specific credit risk adjustments. So these are specific provisions. And of course, some clarity has to be provided around IFRS 9, whether those are also still all specific credit risk adjustments. Also, particularly because in the US we see provisions to be also general or to be considered general credit risk provisions. So the dampening effect basically comes from lowering the exposure value, and of course lowering the exposure value means of course ceteris paribus that the RWA would also decrease, but of course that effect does not basically offset significantly the direct effect on a lower CET1 capital, especially with low risk-weighted assets, so with assets with a low risk weighting. So because the impact is quite significant, the Basel Committee has published a proposal to basically phase in the effects of an increase in loan loss provisions coming from IFRS 9, i.e. Lowering the or dampening the effect on CET1 due to the increase in loan loss provisions. The proposals basically state around a period around 3 to 5 years, and the specific 3 approaches that the Basel Committee has brought forward basically focus on a 3-year phase-in period. The European Parliament has also passed a resolution on IFRS 9, basically providing its positive advice to the European Commission to endorse the standard, and of course it takes, or basically it mentions a couple of attention points, and one of which is the effect on transition, particularly for standardized approach banks, and it basically suggests also to propose a phase-in period, which then we of course expect based on this and based on the Basel committee's proposal to be between 3 and 5 years. So a full, say, permanent waiver, we don't expect that to be the case. So the transitional provision will at least basically dampen the effect or spread the effect over a couple of years. Although, of course, when analysts or other stakeholders look at fully loaded ratios, of course, they will not consider that transitional provision. But it is still relevant, for example, for the so-called distributable amount, the MDA. So this is basically on the link between provisions and exposure values and capital, which is a very important link to take into account and consider when implementing IFRS 9. Moving forward to the next topic, which is said before, one of the effects or links between regulatory and IFRS 9. So this is not around capital, but of course around liquidity, so the liquidity coverage ratio. And what is basically the most important overlap here or interaction here is all around the so-called business model definition and the say liquidity function under the LCR, or the operational requirements under the LCR for the liquidity buffer or the high quality liquid assets. Basically, one step back around the business model, as explained before, so hold to collect business model typically or basically is holding a financial asset to collect the contractual cash flows. And we just put together some, let's say, typical activities around a hold to collect a business model, and then non-typical activities or non-typical, let's say, characteristics of a hold to collect business model are also listed, including compensation or remuneration based on fair value, basically managing the instruments at fair value, and very importantly, selling and buying assets, financial assets within this business model, also, of course, not in line with a hold to collect business model, of course, provided that they are more than insignificant and more than infrequent. But there are, I mentioned the sales, which is very important because we say hold to collect and the other one is hold to collect and sell. So sales are very important. IFRS 9 does provide basically some permissible sales, which is one of which is if a basically simply a loan is sold because of credit risk deterioration of the asset or the counterparty. Assets that are sold close to their maturity. Of course, close to maturity is not specifically or not defined in IFRS 9. So of course, policy has to be drafted around this by the banks. And as I said before, infrequent, insignificant sales are basically also permissible sales. So there are some sales that are allowed, but in general, a hold to collect business model basically means we are holding the financial assets to collect the contractual cash flows, and we're not selling those financial assets. So this is the whole business model hold to collect under IFRS 9, and then under this operational requirements in LCR, or for LCR and the CRR, basically require to evidence basically liquidity of the financial assets that are in the liquidity buffer, in the high quality liquid assets buffer, and by evidencing basically liquidity would normally be by selling financial assets, and of course this it doesn't account for the whole liquidity buffer, particularly not for so-called level 1 instruments. But by evidencing, or to evidence liquidity, normally you would expect selling, and then of course selling financial assets could harm the hold to collect business model principle, i.e. it could lead to not being a hold to collect business model anymore, and hence would by default mean that the measurement of those financial assets have to be at fair value. So either fair value through P&L or fair value through OCI, depending on the so-called SPPI test. However, there is in the CRR, there is basically where the CRR further sets out how to prove this liquidity, and it basically says it could either be through an outright sale, which would harm the hold to collect business model, or through a repo transaction. And a repo transaction generally does not lead to derecognition of the financial asset, and hence is not counted as, or is not a sale for IFRS or IFRS 9 purposes, and hence would not harm the hold to collect business model. So basically, a bank which would go for repo transactions to evidence the liquidity of the liquidity buffer would basically not harm the hold to collect business model, and hence would be allowed, provided the SPPI test is met, that the liquidity buffer would be measured at amortized cost, which of course is interesting, since the liquidity buffer currently with most banks, of course there are some banks, with most banks it's at fair value, and because those assets are generally at classified as at available for sale, which is basically fair value, and the fair value changes go through equity, through OCI. And with some banks in Europe, we've also seen, or we see, a hold to maturity classification, although that is relatively rare, which basically means that if we would classify this liquidity buffer in a hold to collect business model, meets SPPI test, and would be measured at amortized cost, there would be reclassification from fair value to amortized cost. And of course, there are some advantages to doing that, including reducing the prudent valuation adjustment, the volatility, fair value changes either through P&L or through OCI, and so on and so on. And the discussion about the potential reintroduction of the filter is also an important consideration around classification of the assets in the liquidity buffer. So this is quite an interesting basically link between regulatory and accounting and IFRS 9, and we know that many banks have been or still busy actively with trying to understand how the liquidity buffer portfolio would move in terms of IFRS 9 accounting. So then we switch to basically the next overview, which is a quick overview of additional regulatory impacts, which Peter will give us a summary.
Yeah, we picked out FinLab capital requirements for market risk and op risk, and looking at the FinLab templates, the supervisor has published some new templates to cover the IFRS 9 effect. For example, The hedge maturity category has been deleted. There are some changes to cover the new requirements for the IFRS category. The adjustments regarding the impairment and hedge accounting rules, and the new templates we have now are applicable as of March 31st, 2018. But we expect some additional updates on the templates, for example, to cover the voting rights for using some IFRS 9 rules already in 2017. For example, the treatment of some, or the fair value treatment of some liabilities, which are not covered in the current FINMA templates. So we expect on that some updates or clarification from the supervisor how to consider this in the actual, on the current templates. Looking at the capital requirements for market risk, we see that the regulatory authority, they want to have a strong involvement into the banking business. There are very strict criteria for reclassification between the regulatory books, and banks align the regulatory treatment between the regulatory books and the accounting books. There's maybe an impact if the supervisor in every case has to give his authorization to reclassify the positions. There might be an impact on the business model with the trading intent. On the other hand, we see that there are no really clear definitions in IFRS 9 what does trading mean or short term, but on the BCBS 352 or the capital requirement to market risk side, there are very restrictive definitions of trading and short term, and banks are recommended to match both definitions to align this treatment, that every position which is from a regulatory perspective, which is a trading position, must be a trading position for IFRS 9 purposes. So we see a direct link between this definition and so impacts coming from the regulatory side to the business model definition and the classification on the IFRS 9 side. When we're looking at op risk, the business indicator is quite new compared with our actual rules, but the business indicator is already based on the P&L and thus directly linked to the IFRS 9 rules. So every change in IFRS rules with impact on the P&L will be lead to changes and to implications to the op risk indicator based on the P&L components. And looking at IFRS 15 revenue recognition, we potentially see higher revenues because of these new definitions. So we have impacts on the actual op risk or the actual discussed op risk rules coming from IFRS 9, IFRS 15, and we knew on a political side, these rules are discussed. So we also expect an update for the op risk rules the next weeks. We'll see when the European Union will or BCBS, or the next step, the European Union will give us some updates on the actual discussed rules under Basel IV. So from my point, some additional regulatory impacts. Now, Abdellah, our next channel date.
Yeah, thanks a lot, Peter. I think clear. There are quite some, as I said before, quite some regulatory impacts, and we've provided an overview and completed with some additional ones. But the more we work with basically accounting or IFRS 9 implementation and regulatory and the changes around, say, Basel IV, I think the more and more we discover even more, let's say, interaction. So it's, I think it's very good and important to make sure that the, say, implementation of IFRS 9 is not just a finance or for the impairment side risk, say, exercise, but the regulatory basically professionals are also involved in its implementation to understand timely the effects on the ratio. So indeed, the next, of course, we hope you enjoyed this one. The next channel dates are the 28th of October, where he will basically discuss some, we'll do with basically a live WebEx with an interview, challenges and implications of Basel IV. And then we have basically the next special edition, or special edition part 2 of IFRS 9 on the 11th of November, where we will discuss basically in more detail the risk parameters, IRB risk parameters, and basically similarities and differences between IFRS 9 and the regulatory models. So that's for the next date, and of course we hope you will join those. I think for now we would like to thank you very much for your attention and for listening in. Of course, again, if you have any questions, please feel free to reach or contact any of us or your local contact person in your territory. But feel free to do so. We are more than happy to discuss with you further. This episode will be uploaded onto YouTube, so if any of your colleagues didn't have time to join this WebEx, or you just want to basically watch this again and listen, please do so and share with your colleagues or with your peers. For now, again, thanks a lot for joining, and hopefully we will be virtually welcoming you next time. Have a good day. Bye.